Let's dive right into today's explainer because we are looking at an absolutely massive collision between two of the most power-hungry industries on Earth, cryptocurrency and AI. We're watching a high-stakes tech narrative unfold right in front of us, and honestly, it's completely redefining how modern digital infrastructure is built. Today, we're going to break down exactly how a company that's historically known for mining Bitcoin is pivoting its entire identity to become a literal cornerstone of the AI revolution. $19 billion. I mean, just let that sink in for a second. That is a staggering figure. It represents the expected contracted revenue of a single lease agreement over a 20-year term. This is an absolute game changer, not just because of the sheer scale of the money involved, but because it marks a fundamental shift in the digital economy. This isn't your typical commercial real estate deal. This is about securing the single most valuable commodity in the AI space right now. Which naturally leads us to the big question, right? How exactly did TeraWulf, a company that historically made its money validating transactions on the Bitcoin network, manage to land one of the biggest AI infrastructure deals in history with a giant like Anthropic? Well, to understand this incredible strategic maneuver, we kind of have to look away from the blockchain for a minute and examine the macro-level forces driving the broader tech world today. Which brings us to part one. The AI power crunch. So, the ultimate bottleneck threatening to slow down this entire AI boom is a macro-level infrastructure problem. Training and running advanced AI models requires a tremendous amount of electricity, and our physical infrastructure is seriously struggling to keep up with Silicon Valley's demands. To put the stakes of this arms race into perspective, Elon Musk recently highlighted this exact issue on Cheddar. He said, "What we aren't doing fast enough is electrical grid energization." And he's totally right. Chip production is scaling up by an order of magnitude, and tech giants are throwing billions at GPUs. But the harsh reality is that making these chips is dramatically outpacing the power grid's actual capacity to plug them all in. The grid just wasn't built to scale this fast. And you have to understand the fundamental physical difference between these two types of energy consumers. On one hand, you have AI data centers. They require a rigid 99.999% uptime. They absolutely cannot go down. But Bitcoin mining, that is highly flexible. It's what the industry calls an interruptible load. Miners can rapidly curtail their power usage and basically give energy back to the grid during severe weather or peak demand. A Duke University study actually found there's a massive amount of curtailment-enabled headroom on the grid if loads can just be flexible. And since Bitcoin miners already own the land, the power contracts, and the grid connections, they're sitting on the exact ready-to-go infrastructure that these rigid AI data centers desperately need. That sets the stage for part two, the big reveal, Anthropic and justified data. This brings us to the climax of the power crunch and the really creative solution TeraWulf engineered. If you dig into TeraWulf's 10Q financial filings, they explicitly outline this deliberate multi-phase expansion into high-performance computing, or HPC leasing. The company has made a conscious strategic decision to pivot. They're actively prioritizing multi-year hosting arrangements supported by investment-grade counterparties. Basically, they're stepping away from the volatile, commodity-driven revenue of Bitcoin price swings and moving toward a highly durable, predictable model of leasing out raw compute power and infrastructure. So, what does this actually look like on the ground? TeraWulf is currently developing a site in Hawesville, Kentucky, known as the Justified Data Campus. We are talking about a sprawling 790-acre former aluminum smelting facility. And this is brilliant because by retrofitting a heavy industrial site like this, they completely bypass the years-long wait required to build new overhead power lines. The site already has high-voltage transmission lines and fiber optics ready to go. It's eventually going to support 401 megawatts of computing power. And to keep all those AI chips from melting down, they're using a closed-loop cooling system that circulates a mix of water and propylene glycol, which, fun fact, is actually a really common food additive, through these closet-like structures behind the server racks. It recycles the liquid instead of just constantly draining local reservoirs. Now, let's walk through the aggressively fast timeline for this mega campus. TeraWulf officially entered into the purchase agreement for the site in February of 2026. Despite the massive scale of construction required here, they are projecting to bring initial capacity online by the second half of 2027, and they are aiming to have the full 401 megawatts completely operational by early 2028. Moving a campus of this magnitude from acquisition to full AI deployment in just 2 years highlights exactly why AI companies are turning to experienced infrastructure operators. They need speed, and TeraWulf knows how to deliver it. Okay, let's unpack part 3, the strategic pivot itself. So, how does a company fundamentally change its identity and business model so quickly? Honestly, it comes down to swapping out extreme volatility for rock-solid stability. The old model, Bitcoin mining, is intrinsically tied to volatile pricing, right? Your revenue can swing wildly based on global markets and mining difficulty adjustments. But the new model, HPC leasing, specifically a 20-year lease with Anthropic, one of the world's absolute top-tier AI developers. This means 2 straight decades of contracted cash flow, completely insulated from the wild swings of the crypto market and backed by the financial strength of an investment-grade tech giant. It's a night-and-day difference. And we know this pivot isn't just a theoretical boardroom idea, it's a successfully executed reality that has already transforming their business. In the first quarter of 2026, TeraWulf crossed a huge financial milestone. HPC leasing revenue accounted for over 50% of the company's total revenue for the very first time. They've actually been actively curtailing and repurposing their legacy Bitcoin mining infrastructure at their Lake Mariner facility in New York just to support this new AI-driven demand. So they aren't just talking about a pivot, you can literally see it showing up on their balance sheet. But that brings us to part 4, funding the mega project. Because here's the multi-billion-dollar question. How in the world do you actually pay for all of this? Building out a facility of this magnitude in Kentucky requires an estimated $3 to $4 billion in upfront capital expenditures. Let's deconstruct the financial puzzle here. They're looking at $19 billion in expected revenue over 20 years, sure, but as we noted, they need roughly $3.5 billion right now to build the physical infrastructure. To help bridge that gap, TeraWulf made a highly strategic move. They sold off their 50.1% stake in another joint venture, a 168-megawatt AI data center down in Abernathy, Texas, to their partner, Fluidstock. That sale brought in $450 million at a premium to their invested capital. By exiting that joint venture, they freed up a massive chunk of cash to redeploy directly into their wholly owned Kentucky campus, where they maintain total operational control. But of course, $450 million is really only a fraction of what's needed for a mega campus like this. To cover the rest, TeraWulf is reportedly preparing a massive $3.5 billion debt raise, which is expected to be led by Morgan Stanley. They're looking to utilize a combination of leveraged loans and high-yield bonds. This is a particularly big deal because it would be their very first time entering the leveraged loan market, which typically serves companies with higher debt levels and often involves variable interest rates. As TeraWulf's CFO has pointed out, in this new model, the AI customers are the ones providing the wildly expensive servers and chips, while TeraWulf funds the physical infrastructure. So this aggressive debt strategy is essentially the mechanical bridge required to reach that $19 billion revenue stream on the other side. Which naturally leads us to our final section, risks and the horizon. Whenever you're talking about billions of dollars and decades-long contracts, we have to objectively step back and look at what this actually means for TeraWulf's future and what it signals for the broader industry. It really is a classic balance of extreme risk versus phenomenal reward. On one side, you have significant financial exposure. Taking on roughly $3.5 billion in upfront debt, potentially with variable interest rates and a fluctuating market, all before the facility is even fully built, that's intense. But on the other side, the reward is nearly unprecedented in the space. You get 2 decades of contracted, highly stable cash flow and the chance to cement yourself as a dominant player in AI infrastructure alongside a titan like Anthropic. They are quite literally trading the day-to-day volatility of Bitcoin for the long-term, steady commitments of the AI boom. Which leaves us with this final provocative thought to chew on. Bitcoin miners control the land, they control the power contracts, and they have the heavy-duty cooling systems already in place. As artificial intelligence continues its ravenous, unprecedented consumption of the electrical grid, will the rest of the cryptocurrency mining industry follow TeraWulf's lead and completely pivot their operations to serve Silicon Valley? The lines between crypto infrastructure and AI computing are blurring faster than anyone predicted. Thanks for joining me for this explainer, and definitely keep your eyes on the grid, because right now, that is exactly where the real tech war is being fought.